Welcome to the Financial Management module on Managing Audit. This module is part of a series of e-learning modules designed to foster and develop the financial management skills of people working in global health. Each module will offer an opportunity to learn from experienced managers and to engage in learning activities that are designed to apply the skills and concepts to your own professional setting. This e-learning module was produced by the University of Washington Department of Global Health, based on content from the Financial Management Essentials Handbook developed by Mango. Mango is an award-winning UK charity whose mission is to strengthen the financial management and accountability of non-governmental organizations around the world by providing innovative, high-quality in-person trainings, consultancy and recruitment services. This module provides an overview of the basic content, but not the full experience of attending one of Mango's practical and participatory training courses, where the motto is taking the fear out of finance. A library of Mango's own publications, as well as information about their services and their open training program, can be found at the Mango website. We encourage you to visit this resource of information on financial management and accountability. When you have completed this lesson, you will be able to understand what an audit is and why it is important to your organization. You will be able to describe the different types of audit. You will understand the key elements of the audit report and how to prepare for and manage the external audit. First, let's talk about what an audit is. An audit is an independent examination of records, procedures, and activities of an organization, resulting in a report on the findings. There are two kinds of audit, the internal audit and the external audit. As the name implies, an external audit is primarily for the benefit of those outside the organization, for example, stakeholders and funders. The audit should be a positive experience and not one to be feared. It is an opportunity to receive feedback on strengths and weaknesses in systems. Discuss with your auditor ways of improving your accounting systems and procedures. Audits are important for organizations as they demonstrate a commitment to transparency and accountability and bring credibility to the organization. It is also a legal requirement in most countries to have the financial statements reviewed by an independent auditor once a year. Internal and external audits are different in the following respects. External auditors are independent of the organization. External auditors must be independent both in fact and in appearance. External auditors are independent public auditors who provide auditing services on a fee basis. External audits do not alleviate the need for an internal audit function or vice versa. Internal and external audit functions are complementary. Organizations are not to rely solely on audits performed by outside parties to measure the appropriateness and degree of internal activities. Audits by external auditors are not intended to replace an organization's management review of operations and may in fact be limited by law to the scope of the examination they may perform. This limit on the scope may preclude a comprehensive review of an organization's internal procedures. Let's now discuss the key components to an internal audit. Internal auditing is an independent, objective appraisal and consulting function established within an organization to examine and evaluate its activities as a service to the organization. The objective of internal auditing is to assist the organization staff in the effective discharge of their responsibilities. Internal auditors examine and evaluate the planning, organizing, and directing processes to determine whether reasonable assurance exists that the organization will achieve its goals and objectives. Such evaluations, in the aggregate, provide information to appraise the agency's overall control system and the quality in implementing assigned responsibilities. All systems, processes, operations, functions, and activities within an organization are subject to evaluations by internal auditors. Internal audit is a control which functions by examining the efficiency and effectiveness of the overall system of internal control. Internal audit is undertaken for the benefit of those inside the organization, for example, owners and management. Internal audit involves a structured review of systems and procedures as set by the board and managers to ensure efficient and effective practices. It is not an internal policing function, rather an opportunity to improve systems and build internal capacity. The internal auditor's report will highlight findings and make recommendations for action where needed. It may be carried out by someone within the organization, or an outsider may be engaged to carry out an internal audit. An internal audit will include a range of checks as part of the independent review, including financial accounting systems and procedures, management accounting systems and procedures, and internal control mechanisms. The internal auditor reviews the adequacy of the design of the systems of procedures and checks that they are being appropriately implemented. A report is presented to the governing body and management, who respond by taking corrective action, perhaps changing a procedure or training a staff member. There are 3 contributing factors that influence an internal auditor's approach. The economy, paying no more than necessary for the resources needed. Efficiency, getting the greatest benefit with the fewest resources. And effectiveness, how successful we are at meeting objectives or doing the right thing. Unlike the internal audit, the external audit is an independent examination of the financial statements prepared by the organization. It is usually conducted for statutory purposes. External auditors may also be engaged to do other specific assignments, for example, a fraud investigation or program evaluation. The purpose of external audit is to verify that the annual accounts provide a true and fair picture of the organization's finances, and that the use of funds is in accordance with the aims and objectives as outlined in the Constitution. The purpose of an external audit is not to act as a fraud investigation, to prepare the accounts, to provide a certificate to say there are no problems, proof that internal control systems are effective, evidence that accounts are 100% error-free. Although it is not the prime role of the audit to detect fraud, this may of course come to light during the checks that take place. Auditors have thus been described as watchdogs, not bloodhounds. An external audit can be conducted either as part of the annual review of accounts or as a special review by a donor agency. It is conducted by a firm of accountants with recognized professional qualifications. Auditors are appointed by the Board of Trustees, or at an annual general meeting, or by a donor for a special audit. They are independent of the organization employing them. Being independent means that the auditor must not have been involved in keeping the accounting records and is not personally connected in any way with the organization being audited. Auditors only have a limited time in which to complete their work, so they concentrate on testing the validity of a sample of transactions and results rather than vigorously checking everything. Although an auditor's independence must be respected and observed at all times, they are nonetheless providing a service for a fee. You have a right to expect value for money. An audit results in a report addressed to members which gives an audit opinion as to the true and fair view given by the financial statements or the state of affairs of the organization and operations for the period. True means that the transaction did take place and that an asset exists. Fair means that a transaction is fairly valued and that assets and liabilities are fairly stated. If the auditors do not agree with the financial results as presented by the organization, they may issue a report saying that, in their opinion, the accounts are not fine. This could be disastrous for an organization seeking donor support. If the auditors propose any adjustments or changes to the draft financial statements, these must also be approved by the board. The audit report is addressed to the members, and it is usual to formally accept the report at the annual general meeting. Auditors will also often provide a management letter. This is separate to the audit report and is addressed to management. The report highlights weaknesses identified in the internal control systems and makes recommendations for improvements. Managers have an opportunity to respond to the findings outlined in the management letter and explain what action they will take. Now, let's take a closer look at the type of opinions and comments that auditors may report on audited statements. It is required that an auditor state in the opinion that generally accepted accounting principles have been followed and that they have been applied on a consistent basis with that of the preceding year. There are generally 4 types of auditors' opinions. An unqualified opinion has no reservations concerning the financial statements. This is also known as a clean opinion, meaning the financial statements appear to be presented fairly and comply with generally accepted accounting principles. Qualified opinion means the auditor has taken exception to certain current period accounting applications or is unable to establish the potential outcome of a material uncertainty. An adverse opinion is the worst type of opinion that can be issued. This indicates that the financial statements do not fairly present the financial position, results of operations, and changes in financial position in conformity with generally accepted accounting principles. Although this may occur by error, it is often an indication of fraud. When this type of report is issued, an organization must correct its financial statement and have it re-audited, as investors, lenders, and other requesting parties will generally not accept it. On some occasions, an auditor is unable to complete an accurate audit report. This may occur for a variety of reasons, such as an absence of appropriate financial records. When this happens, the auditor issues a disclaimer of opinion, stating that an opinion of the firm's financial status could not be determined. On occasion, donor agencies may request an independent external audit of records and activities and will appoint a qualified person to undertake a review. The primary purpose of such a review is to check that grants are being used as intended and in accordance with the budget in the original funding agreement. The auditor or evaluator will almost certainly wish to interview staff and committee members and may even request to observe the organization in pursuance of its activities. Every effort should be made to be open and honest about organizational strengths and weaknesses. Thus far, we have talked about the different types of audit and the key elements of an audit report. Now let's dive into how to prepare for an external audit. We will start by discussing what the auditor will need. An auditor will need a quiet place to work where the checks can take place without interruption. If individual staff members are to be interviewed, then a private room where confidential discussions can take place will also be required. Depending on the type of audit taking place, the auditor will usually give advance notification of the records needed. Ensure that all the records are up to date and properly filed, as this will facilitate the routine checks and cause minimal disruption to the organization. This will also help to save on audit fees. A checklist of records and other documentation may also be requested by the auditor. When you are ready, click the forward button to learn more about an auditor's checklist. You may find this checklist to be helpful when preparing for an audit. The primary records of account will include cash books completely up to date to the year end, a file of invoices or vouchers for all items of expenditure, a file or book of receipts for monies received, bank statements, deposit slips and checkbooks, wages book and records, and a general ledger if kept. Summaries and reconciliation statements to include a trial balance and/or a summary of all receipts and payments by budget category, bank reconciliation statements for all bank accounts at the year-end cut-off date, petty cash reconciliation statement to the year-end cut-off date, and stock sheets, inventory records. Schedules to include schedule of creditors, money owed by the organization, schedule of debtors, money owing to the organization, schedule of grants due, schedule of grants received in advance, and a fixed assets register. Other information that may be helpful to include a letter from bankers to confirm balances. This will be requested by the auditors themselves. Constitution of the organization, list of committee members and staff, minutes of board and management meetings, and donor agencies' funding agreements and audit requirements. Now let's discuss the key elements to the audit process. The following process is common to most audits, but may vary depending on the content or needs of the audit department and the organization. Planning. The auditor initiates the audit process, gains an understanding of the organization, identifies risks, and establishes specific audit objectives. The auditor contacts and informs management of the reason for the audit and general scope. Meets with management to discuss and obtain general information about the organization. Performs a risk assessment to determine audit scope and objectives. Develops the audit plan and programs. Entrance meeting. The organization's management and audit staff meet to discuss the next steps and functional areas that are included in the audit. The attendees discuss preliminary audit scope and objectives based on risk assessment. Discuss organization concerns or additional areas of audit interest. Review audit and reporting processes. Determine the time frame for audit. Establish an organization's contact person for the auditor staff to communicate throughout the audit process. Establish an organization's contact person for the auditor staff to communicate with throughout the audit process. And distribute a client feedback survey. Fieldwork. The auditor reviews, evaluates, and tests internal controls. The auditor meets with organization staff to obtain an understanding of the internal control structure. Performs and documents audit tests. Identifies weaknesses in policies or procedures or business operations. And summarizes audit results and communicates areas of concern to the organization's primary audit contact. Draft report. The auditor reviews the audit documentation and prepares a draft report to communicate the audit scope, objectives, and conclusions. Provide comments and recommendations related to weaknesses in internal controls. Comments include the following elements: condition, what happened? Cause, why did it happen? Effect or risks, the resulting outcome or impact. Criteria, what should be? Recommendation, what should be done to address the cause? Internal audit staff distributes the draft report to the organization's management. Exit meeting. Department management and audit staff meet to conclude the audit and discuss the draft report. The attendees review draft report content and discuss changes, and determine due date for the management's response. Management's response. Management prepares a written response to the audit recommendations in the draft report. The response includes corrective action to be taken and an implementation timeframe. Audit staff reviews and adds management's responses to the draft report. Final report. The audit staff prepares the report for final distribution to the management. Follow-up. The auditor contacts organization management to determine implementation status of audit recommendations. To recap what we covered in today's lesson, you should now have a better understanding of what an audit is and why it is important to your organization. Describe the different types of audit. Understand the key elements of the audit report and how to prepare and manage the external audit. Congratulations! You have reached the end of the module. Please take this time to revisit any of the content we covered today. When you are ready, click the Home button to return to the main menu.